And joining me now to set up this new week as we head into earnings, more economic data, and of course, an evolving tariff policy is Jeff Krumpelman. He's a chief investment strategist and head of equities at Mariner Wealth Advisors. Jeff, thanks so much for joining. And as we get ready for the markets to open for the week, what do our viewers need to know?
Well, wow. It's a fluid situation. What an open-ended question there. How much time do you have? I would say that it is fluid. The economic data that you said is coming out this week. We're not really focused on all that much because I do think there's been a lot of front run buying to get ahead of these tariffs. And so I expect, retail sales and the other data to be relatively decent. And I think what we're looking for impacts down the road, but we'll be watching the bond market. I think, everyone is probably watching the bond market right now to take signals because certainly the president is as well.
Yeah.
And, we'll go ahead.
I do want to talk a bit more about the bond market, Jeff, because you're right. We did see reports that President Trump was looking at the bond market as he did reverse some of his most stringent tariffs, of course, last week. What is the bond market signaling, and why would that impact the president's policy?
Well, clearly the bond market, yields in the bond market are what all other kinds of interest rates are priced on: mortgage rates, consumer lending rates. And if rates surge, that can absolutely shut down, the economy and certainly, clog the pipes of just the normal lending and spending process. So it's a really big deal. And that was the biggest wild card risk we saw going into the year. At these levels, we're okay. We kind of thought the bond market would hover in a range of 425 to 475, which are normal levels of interest rates. What spooked people was that they shot up from 380. We kind of had this recession scenario going on, and so rates had gone down. It's the volatility. And then as we saw the size of the tariffs and how much they could impact inflation, all of a sudden you saw them shoot up.
Yeah.
Now, there might be other factors. This might be the fact that foreigners are no longer saying, hey, the 10-year treasury is what I'm going to buy in the U.S. If the world sneezes, it's the safest asset in the world. And maybe the fear is that perhaps the appetite for U.S. debt declines and that we'll pierce through that 5% level and we head to higher rates, which would be more of a problem. But, that doesn't have to be the outcome here.
So, Jeff, I think sometimes when we see volatile markets, right, people wonder, should I even be, participating in a market like this? And we saw historic volume. So obviously, there were many participants last week. But for someone who's watching and they might be wondering, should I stay on the sidelines? How should I manage from here? What kind of insight or just really guidance would you give them?
Yeah, I can't help in answering that question. I can't help but give you context for what our message was going into the year. And I think it might be helpful to people. Our message and our theme this year, unlike the prior 2 years where we were extremely bullish and had very bullish themes, our theme this year was clear air turbulence. We have a target on the S&P 500, and we had this going into the year of 6,600. But we said buckle up and expect air pockets because of this policy flow coming out of Washington. Expect 10 to 15% pullbacks that could be significant on that path to higher levels. And while we've taken up our risks of recession to 40%-ish, there still are paths to that target of 6,600. And what you need to avoid is whiplash. Because the news is so volatile, you could easily see us be on that path, and you also could see potential downside. But if the Fed cuts, if we get tax cuts that go through, or if President Trump does back off and negotiate with these other companies, those three different things that could happen could easily take us up in coiled spring kind of fashion to positive returns this year. So you don't prematurely act. You got to wait and think like Ted Lasso or Walt Whitman. Be curious, not judgmental right here. And make sure you've cut back to your normal stock allocation at this point. You want to put a little defense and have some balance in your portfolio. Make sure you don't have too much Mag 7 exposure and concentrations. Be diversified, but you want to hang in there with your equity allocations at normal levels.
So what I'm gathering here is stay the course, stick to your goals, be aware of the market environment. Jeff, we really appreciate you joining the show. That's Jeff Krumpelman joining from Cincinnati. He's the Chief Investment Strategist and Head of Equities at Mariner Wealth Advisors.